What's going on, everybody? It's David Piatek and Lourdes Fernando. Today, we're going to be talking about investment properties and what metrics you should be using when analyzing a property. Now, this series is focused on the military members utilizing their VA home loan for down the road investment purposes. Now, one question we've gotten a lot in the comments section, I want to address this, is that can you use a VA loan to buy an investment property? So there's two parts to that. So one, you can't just straight up buy it as an investment. Like, hey, I'm not going to live in that property. I live in Illinois, but I'm buying an investment in Florida. You can't do that, right? In theory, certain metrics, like if you're on active duty, you have a spouse that's going to occupy it, sure, you can do that. But in general, the things we discuss is that when you are buying a property, you can turn it into an investment property. So it's really important to note that. So, Lourdes, how important are investment metrics when it comes to purchasing a property and thinking about it from an investment standpoint down the road?
Yeah, so we do have a lot of active duty soldiers that come in, or members, I should say, that come in to the area and they say, "Hey, I want to stack my benefits, so I want to buy really low so I can buy a property here. When I go to my next duty station, buy a property there." And that's totally awesome. So what we do
Yep.
is we look at two factors. We want to make sure that the taxes are a little bit low. We want to make sure that it's in an area it's a high rent market area, meaning there's a lot of attraction to it. Is it near public transportation, schools, etc.? So we want to make sure it's in an area that's going to be easily rented out. And then we also look at what the cash flow is, which I know we're going to dive deep into today.
That's
But
today's lesson.
that's today's lesson. So we do look at those things so that they understand, is this going to be an actual really good investment, or is this going to be a money pit where they have to sell and their strategy is not going to work out?
Right. And all that comes down to cash flow, right? Real estate is an emotional thing. But
Yeah.
today we're going to try to take the emotion out of it and just look at the numbers. If you guys don't know, I am a lender and Lourdes is a realtor. So we kind of come on to kind of get both sides of it, right? From a lending perspective, let's look at the numbers, and then from a real estate perspective. So let's dive right into this process. The first thing I want to cover is, and it kind of leads into everything we're going to be talking about, is going to be a debt service coverage ratio and what that means. It is extremely important to understand what a debt service coverage ratio is because it's the foundation of an investment property. One thing to note when you're using a VA home loan compared to other loan programs, because sometimes, Lord, as people come into the mindset of investing and going, well, the numbers aren't working. There's sometimes a reason for that. And typically it's going to be because you're not putting a down payment, right? Most investors are they do a down payment to cover their debt coverage ratio, right? So if they got to put 20% down, 30, 40% down to meet that requirement, that's what they're doing. And Lourdes, from a real estate perspective, they're the forecasting, hey, the property is going to be worth X amount of money in X amount of time, right?
Yep.
They look at it from a depreciation asset standpoint, right? They look at it from a future value standpoint. So investing is very different than buying as an owner occupied, but you have to look at it from an investment standpoint if you're looking for it down the road. So debt service coverage ratio is going to be the net operating income divided by the total debt service. What that means in a nutshell, that if you're collecting, let's say, $10,000 a month in rent, but it's costing you $11,000, you're upside down. Okay.
Yeah.
You typically then would do a down payment to then basically bring it down to you're covered. Most places, what are considered safe, right? And this is a loose term because that's very different and based on where you are and in the country and what type of investment it is. Typically, a 1.2% ratio is what you're looking for, right? So in theory, where's my fancy calculator? You would, let's say for that same example, you would want to be, let's say your expenses are, you're getting 10,000 a month in income, right? And then you're looking at 8,000, let's say, in revenue, like in 8,000 in expenses. So your debt ratio would be 1.25. So 10,000 in income, 8,000 in expenses. That includes your mortgage, any maintenance that you have, repairs, property taxes, insurance, utilities, all that would be included in that. Lourdes, what are your thoughts on the debt service coverage ratio?
Yeah, so that's kind of gibberish to like us. And so I'm going to break it down kind of like what we look for when I'm taking out clients. And then this is really important for you to have a lender and then also the real estate professional come together and help you create a solid plan. One thing I did want to, before I jump into that, I did want to, so hit on kind of something that you said. What happens if you're in the negative and you're trying to go purchase another property? Does that count against you? For example, the example that you gave, the expenses, the mortgage, the repairs, everything like that equals to 11,000. You're only getting $10,000 in rents. What happens when you try to buy another property?
Oh, this is like a separate video altogether, because when you're up, well, I'm not a CPA, disclosure, right? This is for educational purposes only.
Mhm.
If you are filing, but from a lending perspective, if you're filing negative income, right? Then the lender is using negative income to qualify you. So now your income has to make up for that, right? So if you're, let's say, have a W-2 job making 10,000 a month, but now you have, a $10,000 payment, and then you have negative income, all that counts against you for qualifying purposes. And a lot of times, Laura, that's a really good point, because normally what we'll see after the first property they buy, they expense so much that they cannot purchase more properties. So you really, Lord, this is one of those. And then you have to go back and amend a lot of things. And so this happens almost, I would say, majority of the time, where someone's like, "Yeah, I make like 2,500 a month on on my investment. I'm really good to go." And then we look at it, and I'm like, "You are negative income. We cannot use any of this based on how you did your taxes." So, but yeah, go on, Lars.
Perfect. So one thing that we do, we look to see if the expenses, the taxes, everything is going to be a negative. So we're going in and I'll give an example. We have a client saying, "Hey, I want to purchase another property um, somewhere else. And I want I want to keep it as an investment property when I leave out of here. When I'm PCS here, this is what I'm going to do. And this is my strategy." Cool. So the first things we look at is the payment. We look at what the market rent is going for. And then we're going to determine the cash flow potential. What is the cash flow potential that you're going to be able to get so that you don't find yourself in that negative situation, just like how you explained. So I guess that's where it all comes in. We focus a little bit more on cash flow. You focus more on the debt service ratio, just to make sure that they can qualify for this property with no problem and still be able to do what they need to do.
Right. And important to note that the debt service coverage ratio is not affected on a VA loan necessarily. Okay, but I'll go into that
Can
after
you
that.
can you go into that?
You want me to go to that? Yeah. Okay. So remember, when you're doing a VA purchase, they're primarily looking at your residual income combined with debt to income ratios. Okay, it kind of goes. There's no easy formula to say, like, look, if you meet the minimum residual income, your loan is automatically qualified. That's not the
Yeah.
case, because Fannie and we still have to run automated underwriting systems, your loan through their system, right? It can come back and say, uh, we want it to cap at 50% debt to income ratio. We're like, why? So it's looking at
Mhm.
your credit, it's looking at your assets, history, time that you've had your employment, all of that's being factored in, right? So I can't say, hey, 100% this is how it's going to work. But most of the time we have a good idea. A debt service coverage ratio is something that you're applying to the investment itself. We're looking at it from, hey, can you just qualify for this property? Now, if you're buying a multifamily property, which we've done videos on in the past, then we could potentially use that income if you have the proper reserves, which is typically going to be 6 months of principal, interest, tax, and insurance are going to be factored into that. And then we can offset 75% of the rental income as income for you to qualify for the new purchase. So that's why we'll see people with 100% disability ratings that have zero debt potentially qualify up to $1 million if they have the proper assets, right?
Uh-huh.
So we've seen that, right? Look, some people are really good savers. That's why it's really important to budget correctly, and be able to kind of get into that dream situation from our end.
Yeah,
Yeah.
and then also come up with a plan, just like I did, because I had very aggressive goals. I was very specific on what I wanted. So, I mean, I had came to you and I was like, "This is what I want." And you're like, "Oh, well, this is what you got to do." So, making sure that you work with an advisor, someone who can like really make sure that your dreams, your goals, and your plans actually come to light. Um, David, can we hit on the net operating income, because I think that plays a big role into the cash flow.
Yep.
And what is that?
Yep. So, well, there's a couple. Let's go through a couple of things that you have to kind of understand. So, one, gross rental income. That's how much money you're going to have before any of expenses, right? Your gross amount. Now, there's definitely a difference between what the market dictates and what you can rent it for, right? You might be in a slower market, right? Rent might be 1,500, but you want to get rid of it right away, so you might rent it for 1,300, right? So you got to really understand that and talk with somebody that's seasoned with that. Your operating expenses, right? This includes all the expenses with the property. This is like your property taxes. This is going to include your insurance, maintenance, utilities, property management fees, reserves if you need anything for repairs. If you're hiring a property management company, all that's going to be factored in. And you could talk with a contractor as well or a home inspector when they review the property, and they'll tell you, hey, the remaining life for the furnace is 3 years. Okay, now you're thinking, hey, over the next 3 years after you replace the furnace, how much is it? Hey, it's going to be cost 10,000. AC units, whatever needs to be replaced, you kind of want to factor that into that. Your net up. Well, you got a question?
Yeah. It's very important for you to understand if you are it's primary resident and you decide to change your AC, you cannot deduct that as far as operating expenses. However, if you do if you do it like in getting your property ready for a tenant or something like that, then you can deduct it. But then you do have to be careful with the amount that you deduct, because once again, it can count negatively against you. So you just have to do it accordingly. Okay, go ahead.
Yeah, and what Laura's is referring to is talk to a CPA or an accountant,
Mhm.
because like those are things that people will think, don't think that something is logical. Okay, be like, oh yeah, this thing makes sense. This is how I'm going to do it, and then it ends up falling apart. Please don't do that. Talk to somebody.
Yeah.
That's what they're here for. So now with the net, then now let's talk about net operating income. So that's going to be the difference between those two, right? So how much money you're bringing in and how much the real cost of your property is, and always factor in that there's going to be more costs than you think. Okay. So net operating income is calculated as gross rental income minus operating expenses. Okay, that's what you want to look. The debt service is what your mortgage payment is every month. Okay, so that's something you have to you definitely need to know what that is, right? So when you're shopping for a property, like when Lourdes, you guys are looking at it, you have calculations already built out saying, okay, look, this property is 400,000. It brings in 5,000 in rent. Hey, this is kind of where we're going to be, and this is why also in areas that are appreciating faster than the rents, then that's another concern. So you want to talk about that, and let me just clarify what I just said. So when you look at what the rental market is, right? Let's say that let's use an example. The market rent is $8,000 for the properties, but the property mortgage payment is 10,000. So you're upside down $2,000. Now that's an extreme example, okay? And why does that happen in certain markets? I know that's happening in Chicago because there's tons of multifamily properties.
Mhm.
Um, why does that happen?
So some people are in the equity gain. Like they say, okay, I'm going to get X amount of equity in the property, so it's going to be okay because it's a great strategy. And then in other areas, it's not. You want to make sure, like someone was like, yeah, I'm going to get a condo as an investment property. Like, no, like
No,
that's,
please do
that's
not.
not a good idea because they don't appreciate as much. And like with the HOAs always going up and insurance going up, like your
And the
margins are very,
rules.
very small. And then rules can change too.
Yep.
They can say like, hey, you can rent today and tomorrow you can't. And so when looking at that, you do have to look whole picture.
Yep. Yeah, that's a good point. And yeah, and so when you're using your VA loan, like we mentioned earlier, typically you're not putting money down. And that's when this, debt service coverage ratio hurts you. Now there's other loan programs out there, like if you're buying straight up investment properties, they have debt service coverage ratio loans, right?
Yeah.
You're buying as a straight up investment property, but then you have to meet those criteria. And so it's hard when you don't leverage a benefit. If you're sitting on a ton of cash, good for you, right? You could then do it. But if you're not leveraging programs like maybe potentially like a VA loan or FHA, conventional has a minimum 5% down payment option, but you have to qualify for all those as well, right? Um, the other things that you want to consider on that kind of go with that, right? You kind of go into different pieces of like what's going to be the time frame to recoup my expenses, or my how much money I've put into the property, because you may be straight up looking at it and saying, well, if I have to take a loss when I leave, because some people will take that equity piece, right? Some people, I've seen people be okay with $1,000 losses every month because they write it off on their taxes and they know the property is going to appreciate over time. And if you look at one thing that would seem odd to this conversation with that is that if you're losing 1,000 a month for, let's say, on a property, that's 12,000 a year that you're losing. But if your property is appreciating that same amount, right, you're just losing initial money into the property which you're expensing, in theory, potentially on your taxes. But you have to think of the negative implications later, right? If you are buying another property, you can't harp on that enough, because
Yeah.
we see too many people, Lourdes, after their first property, not qualify anymore for others.
Right.
And if you have a multifamily property with a VA loan, you normally can offset a departing residence, but with certain investors and lenders, you can only offset your unit, not the whole building. So it's something to keep in mind when you're going through that. That's I know.
What?
Yeah, yeah.
That
So,
makes no sense.
well, that's the thing. So when you own a multifamily from experience, okay, you are still claiming your current other units on your property taxes, right? So a lender potentially can ask you for your taxes, and then if they see that your current property, you're expensing everything on all the other units, then that can count against you. So that's the risk of all of this, and trying to really lay a foundation out for having multiple properties before you go commercial, right? But then it's a whole different ball game of doing a much larger down payments. What we're trying to do is figure out how you as an individual could leverage benefits that you have now for down the line return on your investment. And that's what a lot of people have done, right, Lourdes? There's plenty of veterans out there that bought homes over the last, prior to COVID, from one after the big crash that happened, that have a ton of equity in their properties. I met someone else down in Myrtle Beach. They're like, we have 4 properties and we have no mortgages on them anymore. And they were like, oh, it was expensive at our time, $160,000. With today's money, you're like, geez, I wish you would have bought 10 of those.
Right.
Yeah, because they're Airbnb, they're all making money, and that's how they're using that money for retirement, right? So that's kind of the end goal, right? Sitting on a lot of cash and equity, you could sell a property like a lot of people are today. That's why the largest transfer of wealth ever happening. But yeah, anything else, Lourdes, that you want to add to close us out?
No, just definitely when you are looking for a property and you do want to keep it as a rental, just keep in mind the lower the expenses, the higher cash flow is ideal, the ideal situation. If you're really close within like $200, I would be very cautious, because if at any point taxes go up, you get a reassessment, it will throw you for the loop. And then also look for areas that have high rental increases, because you want to look to at the trend of like, okay, what is the trend in this area? Are the rents going up? Look at the different strategies as far as in look at our other videos in this series, but see if the rents are they're appreciating, and also the values as well. There's certain areas that are taking big hits. There's also things like Airbnb that have really high restrictions on there. So if that's a strategy, say, hey, I want to do Airbnb. Don't bank on that by the time that you leave, because there may be things that are in place that don't allow you to. For example, like the city of Chicago has a lot of restrictions on Airbnbs. You have to live in the property, etc. Has to be your primary resident. Well, how do you do that? So double check to see what your end goal is. Really come up with the plan when you are. This is one of your goals, and talk to myself or David just to see how you can make that happen.
Yeah, that's awesome. And just one thing to note, you did touch on property taxes, which I was instantly reminded of the disabled veterans property tax breaks. Just remember that when you're, let's say you might be thinking like, oh, I have a VA disability, I don't pay property taxes, based on the property. Remember, you lose that exemption when you turn it into an investment property. And so then you have to figure out what the new taxes are going to be. And sometimes it's just not that easy. Okay. So you kind of have to factor that in because normally taxes and insurance, like Laura said, go up, and that's why you increase rent over time. We got more? Go ahead. Come on.
And when you have an investment property, so I'll give an example. I live in my investment property. I'm buying another one, and my insurance is almost double for pure investment compared to me living in. Now, when I go live in that property, then cool, that's going to go down, and this one's going to go up. So when it's a pure investment, non-owner occupied, the insurance goes up substantially. So factor that in as well.
Well, awesome. Well, thanks, Lourdes, for joining us. We'll be having more videos coming up soon. Make sure you guys hit the like, subscribe button, and we'll catch you guys later.